with Sanjeev Prasad. Sanjeev, fantastic to have you back. It's been a while we haven't interacted on this forum. So Sanjeev, why is India suddenly underperforming global markets so sharply? When we started the year, the general view was that 2018, at least the first half, would be a better year for Indian markets and we will do much better than other emerging markets and developed markets. I guess suddenly the reverse is happening.
I'm not too sure why that assumption was there in the first place that the Indian market will do better
I can see him, I can hear him.
Global markets. Can you hear me? Hello?
Yes, I can hear you, I can see you. Okay, so let's take it up. Why do you think Indian markets are underperforming global markets?
As I said, there was no reason to assume that India would outperform the other emerging markets for the simple reason, India's macro deteriorated pretty significantly in the second half of the last calendar year, while the equity market, was ignoring all the developments over there. Bond yields already started to move up quite sharply. There were concerns about fiscal slippages. Oil prices started to move up, resulting in concerns about the CAD and BOP. So, I guess over the last 1 month, suddenly everything has come into sharp focus. Investors were probably ignoring all the negatives out there. And on top of that, you have seen a lot of country-specific developments with respect to, the banking sector, etc. of late, which has obviously resulted in a big correction in some of the banking stocks. And as you know, banks do account for a fairly large weight in most of the indices. So if you put all that together, that explains why India is underperforming so significantly compared to other emerging markets. So also remember, when we are talking about global economic recovery, India is actually not a very big beneficiary of global economic recovery. So of late, either countries such as Brazil and Russia have done very well. Both have, obviously benefit from higher commodity prices, and in specific case of Russia, they have gone through a period of very, a big improvement on the fiscal parameters. And whereas if you look at some of the other emerging market countries such as be it China or some of the Far East Asian economies, they do benefit from global economic recovery in that they have huge amount of linkages to the developed countries. If the rest of the world is recovering, the exports from these countries should also go up logically. So all that put together makes India in a slightly different position. It's much more of a domestic market, and domestic macroeconomic parameters have worsened significantly over the last few months.
So Sanjeev, I agree that the macro risks have surfaced up. We are no longer in this cozy macro, tailwind, so to speak. So how does one really figure out that this macro cycle which has turned, equity markets are already pricing that in? I mean, how does one judge that the macro adjustment is still on or it is still over?
I think it has some way to go. One simple way to look at it is just compare, how bond yields have moved and where equity yields are. Equity yields are nothing but the inverse of the PE. And you still see a very big disconnect over there. Bond yields have gone up pretty sharply over the last 6 months. They're up something like 125 basis points, whereas equity yields have barely budged. Now you have started to see some correction in the PEs. The other way to look at it is if you look at the more longer term, average price earning ratio juxtaposed with the cost of equity. I think we are still on the higher side when it comes to multiples for many of the stocks, be it in the consumer staple sectors, consumer discretionary, many of the NBFCs and mid caps in general. I think the valuation is still on the higher side compared to what can be justified based on the business models, growth parameters, and the cost of equity, which has definitely gone up in line with the big increase in bond yields of late.
Sanjeev, hi, morning. Is that the bigger fear, the domestic internals and the fact that there are a fair amount of risks that they pose, the hardening yields like you just highlighted to, the fact that it is an election year in the run-up to the 2019 elections, so volatility is bound to be high in any case, that there are risks to what we're going to do in terms of deficit as well as fisc numbers, and the fact that monsoon is also going to be another wait-and-watch game, another month or so, and we would be predicting what the rain gods are going to do. Is that a bigger fear, or would you say the bigger fear is really from global headwinds, what Trump talks are, or slash tantrums? We still don't know how to qualify his commentary as that. So is the global factor a bigger fear right now? Would you say we're tied down with our own domestic internals?
No, I think the domestic factors are much more relevant. The global factors are relevant, and with global bond yields slowly but surely moving up as the economic recovery in most of the developed economies gathers momentum, that will anyway continue to act as as an overhang on multiples. But I think the more relevant factors are what's happening locally. So you have a fair degree of uncertainty with respect to macro anyway. It had deteriorated pretty significantly. The question is, from now, where do we go? If we see some improvement in, let's say, GST revenues over the next few months, then the bond market can start cooling off. But GST revenues currently are running well short of what is required to meet the fiscal 2019 assumption which the government has for its budget purpose. Same way, if you look at inflation, the hope is that inflation comes down in the second half and the RBI will not raise rates, but we'll have to see as to what happens to monsoons. How does the government tackle reports of still some pain in the farm and the rural economy, and what to do with respect to minimum support price for the Kharif season. If you see big increases over there, then clearly inflation is going to be on the higher side. And lastly, we are also faced with a lot of political uncertainty as we head towards the second, third quarters of this year. There's already a lot of speculation building up that the BJP may look at advancing the national elections to coincide with some of the state elections towards the end of calendar 18, early part of 2019. In that case, this whole political uncertainty, gets advanced by a few months. So if you put all that together, we are looking at a fair degree of headwinds as of now. The hope is that everything turns out right in the sense inflation tapers down in the second half as is assumed as of now. GST revenues start picking up, which means there is no longer any big macro related negative surprise. Oil prices remain where they are, which means we are okay on the macro side. But these are big macroeconomic variables, very hard to really forecast which way they are headed, and we will figure out over the next 2-3 months as to what happens to the macro.
Sanjeev, the PNB scam and the ongoing probe by the SFIO is definitely taking its toll on not just PSBs, but some of the large corporate private banks as well. Do you think in this bout of fall, there is opportunity to buy some of these private banking names?
Yeah, we'll have to wait and see as to how this whole situation evolves. But just continuing on the previous point, this is one more big level of uncertainty which has got added now. And clearly there were signs of economic recovery. Some of the high frequency data points were looking pretty good. Companies were sounding more confident. Even the investment cycle was starting to look better. But now suddenly, given all this developments in the banking sector, if the government continues to or I would say the government agencies continue to intervene in the banking sector through whatever means, all sorts of questionings, etc., then I suspect the banking sector may go into a little bit of funk when it comes to lending to companies and also MSMEs. Now, whether the NBFCs and some of the private banks which are so far untouched by some of these issues, they can do the heavy lifting, I don't know. But it does put a fair amount of fear among bankers, especially in the PSU banks, that if every decision of the banks above a certain level of default is going to get questioned by some government agency, then the whole system is going to if not freeze, at least slow down to some extent. I mean, the positive thing, if you look at the banking sector over the last 2-3 months, was that we are getting to what looked like the end of the NPL cycle in terms of recognition. We have started to see a lot of progress in terms of resolution of some of the large NPLs. The first 12 cases probably now coming to closure. But if the government agencies start questioning every decision of the banks, I don't think this kind of situation is going to be very supportive of the banks starting to do aggressive lending once again. So some of the fledgling economic recovery which was visible, that could again start tapering down, which is definitely not going to be good for the economy.
Okay. Well, the breath is better, but the breath is not convincingly better. Sanjeev, where are you reasonably confident of earnings? Uh, where do you think markets are still not very convinced and earnings could surprise us? That's part A of my question. Part B, where do you think earnings will not surprise us? And the positioning seems to be indicating that institutional investors are overweight.
See, I am not very sure now if earning numbers are really going to surprise on the upside, to be honest with you, because earlier, as I was saying, we had hopes of economic recovery, but I'm not very sure after some of the recent development respect to the banking system. We had started to build in pretty large amount of turnaround in some of the banks based on the fact that loan loss provision numbers will start to come off incrementally, but now based on one, the RBI's directive, which effectively results in all the previous dispensations being removed over a period of time, and effectively, if you don't have resolution in some of the larger cases over the next 180 days, then they have to be referred to the NCLT, which means that you could see provisions still being on the higher side over the next 2 to 3 quarters, which means fiscal 19 numbers also start getting affected. And one of the big areas we were starting to see a lot of earnings growth was from the PSU banks and also some of the private so-called corporate banks like an Axis and an ICICI. But I suspect we may have to tone down the numbers over there. Metal and mining also, things were starting to look good, but I don't know where we end up with respect to this tariff wars. Hopefully, nothing much untoward happens over there, but let's see as to how this whole situation develops over the next few weeks with respect to the imposition of tariffs by the US. In sentiment for the PSU banks. There's also some of the private corporate banks which have got hit quite badly over the last couple of weeks, and even you could see some recovery in the metal mining names. I mean, so far we are holding on to our earning numbers, but whereas the market definitely is not very convinced about the earning numbers holding up. So if there is any improvement, if you could see a big rally again these stocks. And maybe not too much of earnings cut, but as I said, let's wait and see how this whole situation evolves going forward. The rest of the sectors, I don't think any of these developments would really affect them. So yes, there could be some slowdown in the economy, and the economic recovery which we are looking at maybe slightly more moderate in that case. So you could see some of the consumer discretionary areas such as autos, etc. Maybe the volume numbers could be lower side, but beyond that, I don't think we will see too much of earnings cuts as yet. I think it's more a question of where multiples settle, given the whole macro uncertainty which is starting to become a much more relevant factor in the market now compared to last 3 years when you had very good macro and not too much of earnings growth. We are into a situation where we have started to see some earnings recovery, but weakening macro, and now suddenly people are starting to focus on the macro a lot more, which means the multiples have to realign to more realistic levels.
Okay, so Sanjeev, closing comments. What do you think is in store from some of these so-called haloed stocks, Titan, HUL, Page? These are good companies, and macro frankly is going to be not a driving factor for their businesses, but the P multiples are just at a record high. So for those who are either owning HUL or a Britannia or a Colgate, what should they expect now?
See, the thing is how the whole situation develops. If you start seeing other sectors starting to become more fancied or more favored once again. If some of the factors which we discussed, start or become less relevant, and you will start seeing economic recovery, then you could start seeing some other sectors such as investment-related sectors, the corporate banks, etc., starting to come back into favor once again. But if the situation continues, in those sectors such as metal mining, the corporate banks, PSU banks, etc., then people will continue to to stay in these areas and give a much higher multiple than is justified. That's more in the short term. If I look at more in the medium term, I would be worried about the multiples. They will probably normalize over a period of time. And if you plot the US 10-year bond deals with the earnings yields of any of these companies, you would see a very, very close correlation. So as global bond deals, in this case I'm just using the US 10-year yield as a proxy, that started coming down, you started to see a big rating in the multiples of the stock. So logically the reverse should also apply as you start seeing some of the central banks in advanced economies starting to unwind the monetary accommodation which has been there through reduction in the QE programs or higher or I would say higher interest rates. You could start seeing bond yields slowly moving up as they have had in the last few months, which means logically you start seeing the P's of this the so-called halo stocks starting to correct to more normal levels. So I think you would still see some correction in these names in terms of multiples. I suspect it would be more through a period of time correction, which means the earning numbers still need to grow and catch up with the stock prices. If you look at, for example, in Asian Paint, the stock hasn't done anything for the last 1 year. I think it's up about 6-7% over the last 12 months. In a way, the time correction is already on over there. Hindustan Unilever obviously has done very well over this period, but that's more under the assumption that they will continue to grow their margins, and that is something which I worry about. That the street is already building in very high margins also for many of these for these companies. So between let's say 2014, 15, 16 and 2018-19, I think most of the street would assume something like 300-400 basis points improvement in the EBITDA margin. Now whether that will hold up or not, we'll have to wait and see. So I do see a fair amount of challenges over here in terms of multiples probably starting to derate over a period of time. A lot of it will depend on what happens to other sectors. If other sectors become more favored, then maybe the multiples could correct a lot faster. But even otherwise, I see some normalization in multiples over there. And the second thing to keep in mind is whether the margins will continue to hold up at.
Okay, Sanjeev, we're going to leave it there.